I'm here in Dallas for REITWorld 2011. I'm joined by Stephen Marks, Managing Director with Fitch Ratings. Stephen, as a whole, what is your take on the state of REIT balance sheets right now?
Balance sheets are much better than they were a couple years ago. The way we think about balance sheet quality is on a couple of different fronts. One, on the asset side, is development. And what we're seeing is speculative development is dramatically down from what we saw in the peaks of 07, 08. And then secondly, on the right side of the balance sheets, we think about leverage and liquidity. Leverage, as we think about it from a debt-to-EBITDA standpoint, down substantially from the peaks. Companies have done a really good job in raising equity to delever their balance sheets. And then secondly, liquidity, which ties into the equity raises. Liquidity has improved dramatically. Companies have substantial capacity under the lines, not a lot of debt coming due. So we think the balance sheets are very strong right now for REITs.
And have you seen a change in terms of lenders' willingness to issue debt capital to REITs?
Well, we've seen there's definitely been a shift. On the secured side, the CMBS market still does remain choppy. There's been pockets of activity. Right now it's slow. The insurance company is extremely active. They've really taken a lot of the market share from the CMBS lenders, and they like to lend on good quality assets, which REITs own a lot of. On the unsecured side, it's been choppy as well. We've seen some relatively recent issuance, but for the most part it's been pretty slow. I think a part of that is because spreads have widened out substantially, and a lot of issuers don't want to borrow at these spreads. But all-in spreads do remain attractive, and we feel like there is a very wide and large investor base to take up some of the unsecured issuance. And
what is the relationship, in your opinion, between leverage and credit quality with corporate governance?
It ties into a couple things. One is just generally, does the board and management have a focus? Do they think about credit? I'd say a couple years ago there probably was not as much of a focus on credit as there is now. So there's definitely now more of a focus. And the second thing is incentives. If we see that companies and managements in particular are being rewarded for having strong credit quality and maybe for not reaching as much in terms of reaching for FFO per share growth, we view that as a positive thing.
Stephen, thank you very much for joining us.
Thank you very much, Matt.
For more from REITWorld 2011, be sure to visit REIT.com.